For those who call out to be short treasuries, who say the next move is one much higher, what do they have wrong?
Well, I've heard that call all year. And I suppose today's yield is about the average for 2021. We're sitting right in the middle of where we started the year, close to 1%, and where we peaked at the end of March. For me, we have to look through the noise and the daily inflow of data and views. Ultimately, if rates do start going up, if and when they do start going up, they're not going to go very far, and they simply can't. And I think what people are missing is, one, there's so much debt in the US and global economy, therefore making each step highly leveraged, really. Each rate hike is really important. But also the size of the balance sheets, the size of the central bank balance sheets, are still going to grow another $1.5 trillion in the next year. In the case of the Fed, this is part of the tightening process as they step away from the QE. So that, again, mitigates the amount of rate hikes that will eventually come through.
But Stephen, even if it mitigates it, how will the markets interpret it? Could we actually see a tantrum?
Well, markets are having to learn how to deal with this. Many people and even central bankers are conditioned on the experience of 2013, the so-called taper tantrum. But there's plenty of academic research, and we've done some ourselves, to identify that QE is really about signaling the next steps. And event-based studies have shown that really it's not the asset purchases that have driven the yield lower. People want to believe that, and fine. But to me, the fear that the reduced purchases mean higher yield is false. And if you want to focus on the supply narrative, remember that the US Treasury is going to cut the supply of bonds going forward. In fact, the reduction in supply will actually dwarf the reduction in the Fed purchases.
Yeah, the Treasury in its refunding announcement last week saying it does expect to reduce those bond sales at least come November. So, Stephen, I look at places like Goldman Sachs and JP Morgan, which are coming down closer to you. They've re-rated their year-end forecast for the 10-year lower, but still Goldman is at 1.6%. So what is that difference of 60 basis points, and what could go wrong in your forecast that gets us nearer to what Goldman is calling for?
Well, the consensus, I guess the median is close to 180 for this year, 2% for 1 year's time. It seems to me to get anywhere near to 2%, you've got to believe in something in the form of a regime shift, something really uber-hawkish, beyond what we've seen in the last few months, and that is very, very unlikely, in my opinion. It seems to me that we're just muddling through, and the range is probably something like 120 to 170 in the near term. To me, on balance, the risks are that yields end up nearer to 1% than 2% at year end, and the facts of the matter are, they currently are nearer to 1% than 2%. And if you'd asked people that a few months ago, that they wouldn't have believed it.
I know you're also mildly bearish, Stephen, on inflation-linked bonds. I mean, what would make you change that?
Well, that's a consistent stance, Francine, to being bullish or to being positive on the treasuries. So the idea that treasury yields could be lower is consistent with the idea that we would be mildly bearish on inflation-linked bonds. Now, especially in the ultra-long maturities, because we see value in the 30-year nominal treasuries. And in fact, once we get above 2%, it reminds me that we've made several buy recommendations whenever we've been above 2% for the nominal treasury. So the thing is, I think it's fairly safe to be either long the treasury or if you prefer, to be short of the inflation-linked products at the longer end, because it's all in the price. And the point is that the inflation break-even is factoring in all available information, including today's CPI release, which I doubt highly is going to shock the market. We've had plenty of time now, quite a few months, to prepare for this 5 handle that we're seeing on the year-on-year print. And we're probably right at the peak now, and it will start coming down.